think about this for a minute. How many people in your actual friend group, people you personally know, have made serious, life-changing money from day trading? Take your time. Because for most people, that number is 0, or maybe one person who made money once, then gave it back. And yet if you have spent any time on TikTok, Instagram, or YouTube in the last 5 years, you would think everyone is getting rich trading stocks from their bedroom. These are not opinions. These are peer-reviewed academic findings from one of the most rigorous studies ever conducted on retail day trading, tracking tens of thousands of traders over multiple years. In this video, I am going to show you why the numbers look this way, the 5 structural reasons day trading destroys retail accounts, and what the data says you should be doing instead. This is the information brokerage apps need you to never see. Here is the mechanism behind the illusion. Once you see it, you cannot unsee it. When a day trader genuinely makes money, what do? They post about it. They screenshot the green portfolio. They make the TikTok. They go on forums. The dopamine hit of winning combines with the social reward of showing off, and the content spreads. When a day trader loses money, which, as you now know, is 97% of persistent traders, what do? They go quiet. They do not make the "I lost $18,000 trying to scalp NVIDIA options" video. The shame, embarrassment, and financial pain go private. The algorithm never sees it. You never see it. This is survivor bias. And financial media does not just benefit from it, it profits from it. Viral trading videos create ad revenue, platform watch time, product placements, and brokerage affiliate fees. Every "How I Made $10,000 in a Day" video makes money for everyone except the people trying to copy it. Your financial content has been filtered by algorithms that reward sensation over accuracy and spectacle over truth. Your perception of day trading success has been systematically distorted.
Now, I want to show you one data point that reframes what good actually looks like in trading, because it changes the entire conversation. Here's a question that sounds absurd, but the answer will recalibrate everything. What percentage of professional hedge fund managers, people with PhDs, teams of analysts, billions of dollars, and access to every data feed and trading tool on Earth beat a simple S&P 500?
Now ask yourself, what does that say about a retail trader sitting at home with a Robinhood account and a YouTube education trying to beat those same markets? This is not meant to discourage you. It is meant to give you the accurate baseline that most trading content hides from you. Let me show you exactly why day trading is structurally difficult. Reason number 1, the bid-ask spread. Every time you buy a stock, you pay the ask price. Every time you sell, you receive the bid price. The difference between those two numbers is called the spread. It may look tiny on one trade, maybe just 1 cent per share, but day traders do not make one trade. They make dozens, sometimes hundreds. On a $10,000 account making 50 trades per day, even a tiny spread can become a serious cost. If the spread is only 1 cent per share and you trade 100 shares per order, that can become $50 per day. That is around $1,000 per month, $12,000 per year, on a $10,000 account. And here is the dangerous part. You never see it clearly. There is no line on your brokerage app that says spread cost, $50. It is built into the price. It silently disappears from your returns. Market makers and institutions earn that spread. Retail traders usually pay it. That is the first hidden cost most beginners never calculate. Reason number 2, short-term capital gains tax. In the United States, if you hold an investment for more than 1 year and then sell it at a profit, you usually pay long-term capital gains tax. But if you hold an investment for less than 1 year, which is basically every trade a day trader makes, your profit is taxed as ordinary income. So even if a day trader makes money, they still have to beat the market, beat the spread,
and then beat the tax disadvantage. The tax code rewards patience. Day trading fights against that structure. Number 3, emotional decision-making. Trading is a psychological war fought in real time against your own nervous system. And your nervous system was not designed for financial markets. When your position goes up, you feel excitement. When it goes down, you feel fear. When it keeps dropping, you feel panic. And when it recovers after you sold, you feel regret. Loss aversion tells us that humans feel the pain of a loss much more strongly than the pleasure of an equal gain. That means when a trade is down $500, the pressure to stop the pain is extremely strong. So what do many traders do? They close winners too early to lock in the dopamine of being right, and they hold losers too long because accepting the loss feels unbearable. This creates the classic retail trading pattern: small wins, big losses, again and again. You cannot simply tell yourself not to feel emotions. Those emotions are automatic, and in fast-moving markets, they become expensive. Reason number 4, you are trading against algorithms. When you place a trade on Robinhood, Fidelity, or any retail brokerage, who is on the other side of that trade? In many cases, it may be a high-frequency trading algorithm or a professional market maker. These systems execute thousands of trades per second. They process news events in microseconds. They operate with data feeds, infrastructure, and speed advantages that cost millions of dollars to build. Your human reaction time, even if you are fast, is around 250 milliseconds. A high-frequency trading algorithm can respond in less than 1 millisecond. By the time you see a price movement, think about it, react emotionally, and click buy or sell, the algorithmic traders have already acted, profited, and moved on. This does not mean every trade is rigged, but it does mean the playing field is not equal. Retail day traders are not competing against other beginners in a fair little game. They are often providing liquidity to systems they cannot see, cannot match, and do not fully understand.
Reason number 5, the pattern day trader rule. In the United States, FINRA has a rule called the pattern day trader rule. If you make 4 or more day trades within 5 business days in a margin account, and those trades are more than 6% of your total trades in that period, you can be classified as a pattern day trader. The consequence? Your account must maintain a minimum balance of $25,000. If it falls below that, your account can be restricted from day trading until it is funded again. Now think about the audience most trading content targets. People with $1,000, $5,000, $10,000. For those people, systematic day trading becomes almost impossible unless they can keep a $25,000 cushion. The viral trading videos rarely mention this. They show the wins. They do not show the restriction screen. Now let me show you the comparison that makes everything click. Scenario A. You start day trading with $10,000. After spreads, taxes, emotional mistakes, and constant stress, let's be generous and say you end up flat. After 10 years, you still have $10,000. Scenario B. You put that same $10,000 into a simple S&P 500 index fund. No trades, no decisions, no screen time.
Let me show you a comparison that will make everything we have covered click into place. Scenario A, day trading account. Starting capital, $10,000. Average day trader return, after spreads, commissions, taxes, and behavioral errors, studies estimate net negative returns for 97% of persistent traders. For the purpose of this comparison, let us be generous and use 0, flat. After 10 years, $10,000. Scenario B, $10,000 in VOO, S&P 500 ETF in January 2014. Invested passively, no trades, no decisions, no screen time. After 10 years to January 2024, approximately $32,000 to $34,000 in total value, a 220 to 240% gain. The average day trader, after all the hours, the stress, the risk, the tax liability, the spread costs, ended up with less money than someone who did nothing. Not because they were foolish, because the structural mathematics of day trading make this outcome almost inevitable. This is called opportunity cost. The cost of day trading is not just what you lose in bad trades. It is the compound return you surrendered on every dollar that spent time in a volatile trading account instead of quietly growing in an index fund. So if day trading is this structurally difficult, what does the evidence actually say you should do? I want to be very clear here. I am not telling you what to do with your money. I am telling you what the evidence says works. And the evidence is not ambiguous. Dollar cost averaging into a low-cost, broad market index fund, specifically something like VOO, VTI, or FXAIX.
Dollar cost averaging means investing a fixed amount on a fixed schedule, monthly, for example, regardless of market conditions. When markets are down, that fixed amount buys more shares. When markets are up, you own more of a rising asset. Over time, the volatility that destroys day traders can become an asset for the long-term investor. In 2008, Warren Buffett made a public $1 million bet. He wagered that a simple, low-cost S&P 500 index fund would outperform any selection of 5 actively managed hedge funds over the 10 years ending in 2017. The hedge funds were selected by Ted Seides of Protege Partners. These were not amateurs. These were some of the most sophisticated professional investors in the world. At the end of 10 years, the S&P 500 index fund had returned 125.8%. The hedge fund's average return was 36.3%. Buffett won by 89 percentage points, and the winnings went to charity. Buffett's conclusion, stated publicly many times, for most ordinary people, a low-cost index fund, bought and held consistently, is the single best investment strategy available. Not because it is perfect, because for the average investor, everything else is usually worse on a risk-adjusted, after-fee, after-tax basis. If you want to start today, here is what the evidence supports. Open a brokerage account, buy one fund, VOO, VTI, or FXAIX. Set up an automatic monthly purchase for whatever you can afford, even $25. Enable dividend reinvestment. Then stop watching the account daily. Here is the whole video in one sentence. Financial media profits from convincing you day trading is accessible and common, but the evidence shows 97% of persistent day traders lose money, while passive index funds beat 80 to 90% of professional active traders over 10 years. That is not a reason to feel bad about being curious. Curiosity is healthy, but curiosity informed by data beats curiosity fed by survivor bias. If this gave you data you had not seen before, subscribe right now. Every week, I publish evidence-based videos with no fluff and no agenda except helping you make better financial decisions. Next, Roth IRA versus 401k. Which wins, when, and what priority order you should follow. Drop a comment. Have you ever tried day trading? What happened? No judgment. I'll reply to every comment.